All right, this is problem 4-1A. This is a really long one, so I'm going to have to do it in parts. So this is part one. This is the beginning of it. Problem 4-1A is found on page 185, and they're giving us a trial balance. It's not an adjusted trial balance, it's just the trial balance for this company. And they're also giving us some information to make the adjusting entries. First of all, let's look to see what our time period is. And this company, Thomas Magnum, started his business January 1st, and we're preparing financial statements um, for the period ending March 31st. And it looks as if we're also going to prepare closing entries for the quarter. Now that's unusual, so I don't know um, why your uh, textbook will be giving you just a 3-month period there, January 1st to March 31st. But let's assume it's their operating cycle, and you usually, you know, you're going to make your closing entries at the end of your operating cycle and start new again. So, um, all right, let's look at the adjusting entries. What I did here on this spreadsheet was just put the amounts, the trial balance amounts right here. There's my assets. Um, let's see, here's a contra asset account. Payable means liability. Here's my owner's equity accounts, right? I have the drawing in the capital, then I have a revenue account and my expense accounts. All right, so it's all in order. And then down below here, I have an income summary. What this problem is going to show you is how to prepare a worksheet to help you um, make your adjustments, create your adjusted trial balance, and then create a post-closing trial balance. Your textbook is showing you a different type of format for a worksheet. Um, well, I'm going to show you mine, right? Just a different way that you can look at a worksheet. All right, so the first adjusting entry that we need to make is number one, supplies on hand total 380. All right, well, in order to make this entry, I like looking at a T account. Well, we don't have a T account for it, but what I can look at is just the balance here. I have a balance in my supply account of 1,050, and I need, well, not that I need, but the balance on hand after we take a physical count is 380. So the balance here, after I make an adjusting entry, needs to be reflected as 380. All right, so my adjusting entry needs to be a credit, and it will be the difference between these two. So I originally had 1,050, I want 380, so my adjusting entry is 670. That's an expense. Those were supplies that I used. So the adjusting entry will be a debit to the supply account, supply expense, and a credit to the supply account for the 670. And why don't we post that? That's an adjusting entry. That's our first adjusting entry. So it's a debit to supply expense of 670. Let me come down here. Here's my 670 that I'll put in for the supply expense, and it's a debit. And then my corresponding credit will be to the supply account. And I already have that one reflected. All right, let's look at our second adjusting entry. Depreciation is $1,000 per quarter. All right, depreciation expense and accumulated depreciation go hand in hand. Every time I'm recording depreciation, I'm going to use these two accounts. All right, an expense is always debited, right, in any type of journal entry, except of course when we're making our closing entries or a correcting entry. But here I'm debiting depreciation expense for 1,000, crediting accumulated depreciation for 1,000. All right, so let me post that. Down here, I'll put depreciation expense 1,000, and then accumulated depreciation will be a credit of 1,000. Okay, so we have that reflected. All right, the third adjusting entry, interest accrued on a 6-month note payable issued January 1st, $300. So they're not telling us to do any calculation. They're telling us for the 3 months. It was issued January 1st. We're preparing it March 31st, our financial statement. So the interest that has accrued that we will owe is $300. Well, that's an interest expense in this period, in this quarter that I want to record. I've earned that, I've incurred that $300 expense. I want to record that. And then I'll, since we didn't pay cash yet, we won't pay it until the 6 months is up. I want to record a payable amount, and that's my interest payable account. All right, so let's post that. Interest expense is a debit of 300, and interest payable would be the credit of 300. Okay, my next adjusting entry, insurance expires at the rate of $200 per month. When you see that insurance has expired, or even the prior one where it said interest accrued, you know you're making an accrual adjusting entry. That means you're pulling the expenses into this current period. So obviously, if insurance has expired, that means I must have had an a prepaid insurance account. And we do. It has a balance of $2,400. So we must have prepaid our insurance, but I want to record part of that expense because I have insurance expense. I'm going to accrue part of that prepaid insurance amount into this quarter. So I'm going to debit insurance expense, and I'll credit that prepaid insurance for the $600. So we have our insurance expense. I'll record that now in my worksheet. Insurance expense of $600. And prepaid insurance will be a debit. Wait, what did I do? Yep, sorry. Prepaid insurance will be a credit of $600. Okay, the last adjusting entry, they tell us that services provided but unbilled at March 31st total $530. Okay, so we provided services. That means that we earned revenue, but we haven't billed our customers yet. So that's an accounts receivable. All right, so and it totals $530. Well, if I earned revenue, I know I'm going to be crediting the service revenue account, and then I'll record this receivable. So I have a debit to accounts receivable for $530 and a credit to service revenue of $530. So let me record that in my worksheet. Where's my service revenue is a credit of $530, and my accounts receivable. So people, you know, my customers will owe me $530. Excuse me. Okay, so that those are my adjusting entries. Now that they're in the spreadsheet, all I want to do is carry it over to my adjusted trial balance columns. And I'm just going to copy over what I have, unless of course, what I have in the trial balance, unless of course I have an adjustment to that amount. All right, so cash is 11,400 debit. There's no adjusting entry, so I'll put that amount in. 11,400. Accounts receivable, I have a debit balance of 5,620, and then I want to add this additional adjusting debit of 530. My supply account should have a $380 balance because of that adjusting entry. We have a back over there. We have a debit 1,050 and a credit of 670, and that'll give me the 380. All right, let's see. Prepaid insurance. I have a debit of 2,400, and yet I want to reduce that by the adjusting entry, which is a credit of 600. So really what I'm doing is just netting my debits and credits. All right, equipment, there's no adjusting entry, so I'm going to carry over that $30,000 equipment debit. I have accumulated depreciation. I have no beginning balance for accumulated depreciation, but I do have a credit, an adjusting entry of 1,000. So I'll plop that in there as a credit. I may have to continue this in the next part, but let's see how far I can go. I may have to cut it short real quick. All right. No adjusting entry for this one, 12,300 for accounts payable. I have a $300 credit I'm carrying over for interest payable. Notes payable is 10,000. The drawing account, nothing additional, $600 drawing as a debit. Um, let's see, my capital is showing reflecting 20,000 credit. Um, the service revenue, I have additional service revenue. I have the original 13,620, and then I'm going to add the 530 to it. Oh, I got to make that wider. All right, I'm going to stop right now, and we'll continue.